In this week's video, we'll review the latest charts to help us answer the million-dollar question. How concerned should stock market investors be about the trade war? You can make an argument that the trade war issues that the market dealt with this week were somewhat unexpected. However, it was not particularly surprising that the stock market pulled back this week. April 19th video, the bullet points that we covered. Short term is becoming more vulnerable to a normal and to be expected 4 to 10% pullback. We covered the same bullet point a week later on April 26th and again on Friday, May 3rd, just 2 days before the president's Sunday tweets related to trade. Thus, when the market's becoming more vulnerable to a pullback, from a probability perspective, we don't know what issue is going to cause the pullback, but historically, every single 4 to 10% pullback in S&P 500 history was associated with some type of political or fundamental concern or a list of concerns. The trade war is obviously a topic that investors should take seriously. We've covered numerous setups in recent weeks that had a bullish slant, including the stock versus bond weekly MACD setup that we covered on May 3rd, a relatively rare bullish cross on the monthly chart of VGT covered on May 3rd, and another recent example was covered on April 19th, where we had a very, very rare move in the summation index, which helps us monitor market breadth. Thus, given renewed concerns about the trade war and stock market action over the past 5 trading days, is it time to take the bullish setups that we've covered in recent weeks and assume they've been negated? Thus, let's examine another question. Was it 100% smooth sailing after a signal like this historically? What type of drawdowns did the S&P 500 experience historically after getting this type of bullish cross, a cross that's very, very similar to the one that occurred in early May of this year? And from a historical perspective, does trading activity in the past 5 days and the new fundamental concerns negate this move in the summation index from a historical perspective? Thus, to help us answer that question, we looked at the maximum drawdown walking forward from the historical signals, the same historical signals that we covered on May 3rd and in a video dated April 19th. So to give you an idea of what we're looking at, these VGT dates here are the dates of a very, very similar bullish cross that occurred historically, very, very similar to the cross that we experienced recently in 2019. And the table shows the maximum S&P 500 drawdown walking forward from the day of the historical signals. We're doing the same thing here for the stock bond analysis that we covered and walking forward from the date of the signal in each one of these historical cases. Thus, when you look at this table and you see a negative 7% appearing 4 times, it tells us that the lowest low after the signal in the S&P 500 was made between 30 and 45 days after the signal. After the 45th day, we never printed a lower low on a closing basis. Looking out 5 to 90 calendar days from the date of the historical signals, the median drawdown was roughly 3% and the maximum drawdown was a little bit over 7%. How does that compare to what we experienced over the past 5 trading sessions? This is the maximum intraday drawdown that we've experienced thus far. It's from the highest high intraday here to the lowest low intraday here. This is the same calculation using closing prices. The midpoint of these two numbers is roughly 3.5%, telling us that the 2019 drawdown aligns very well with the drawdowns that the market experienced after similar bullish setups in the past. Thus, we really haven't seen anything over the past 5 trading days that would negate the bullish setups that we've covered in recent weeks and recent months. And since we're walking forward 90 days from the date of the signal, and given what promises to be a very uncertain month of May relative to the trade negotiations, it's still very, very possible that these numbers will get larger. And even if that's the case, it still would align with what happened historically after these bullish setups. We noted earlier, it's not particularly surprising that the market pulled back over the past 5 trading sessions. What we didn't know back here was what the fundamental triggers would be, or the triggers from the news cycle. As it turns out, it was renewed fears related to the trade war. And from a technical perspective, it's not particularly surprising that the market pulled back based on this gap that was left in the rearview mirror that we tweeted about back on April 17th. In the tweet, not unusual for the market to backtrack and fill gaps. Here's the gap mentioned in the April 17th tweet, and you can see the market came down on Thursday, filled the gap, and then rallied and closed above it. Friday intraday, this tail here tells you that we tested the gap again, had somewhat of a false breakdown below the gap, and then rallied strongly into the close. In a Monday, May 6th short takes post with this title, we said, should the market decide to revisit the gap here, it could represent an opportunity to redeploy some of our cash. And for clients, this post contains a little bit more detail relative to the rationale behind taking some profits in SCHB on Monday of this week. And as we're falling here, we're not making any assumptions about what may or may not happen in the gap here. And as the week unfolded, the evidence that we had in hand allowed us to buy on the other side of the gap here intraday, make a small buy again at the close on Thursday, and another small add from a percentage basis near the close on Friday. Since we know that market fractals tell us that similar setups occur on different time frames, this move back to fill the gap allowed us to use some of the bird strike concepts that we've learned over the past 3 to 4 months. The core market model is still showing extremely strong trends on May 3rd. Many of the tools that we have in our bird strike arsenal are telling us that this bullet point should be respected. When the market moved back into this area, we did get constructive price action, and we still had very, very strong trend strength scores, and a handful of bird strike related tools also showed improvement in this area. For example, market breadth in the morning on Thursday, extremely weak. By the end of the day, significant improvement. As noted on Twitter, on Thursday, the VIX closed 17.8% below the intraday high. And on Friday, late in the session, we were almost 30% below the intra-week high. How is this helpful relative to probabilities and possibly redeploying some cash? Here, when the VIX is spiking, it tells us that market participants expect volatility to continue. These moves here tell us we have waning expectations related to volatility going forward. All of this is obviously subject to change over the next 30 days due to this issue. But the facts that we had in hand on Thursday and Friday were constructive relative to the possibility of a reversal. The reason for bringing this up, the concepts that we're using up here and the concepts that we're using down here can be applied to longer term time frames. Thus, this A to B move here is not radically different from this A to B move here. In September, early October of last year, the model, and especially the trend strength portion of the model, still very strong here, and conversely still very weak here, but bird strike related tools were flashing some warning signals here, and bird strike related tools were saying pay attention down here. Concepts that can be applied to this point here and this point here. So conceptually, when the market is down here, one of the reasons that we know about this is we have this chart of the VIX in our bird strike toolkit. These thin green dotted horizontal lines here tell us these were levels where the market reversed after a VIX spike, simply telling us when the VIX got into this area here, we should be more open to considering deploying capital if price action and other factors supported that type of decision or move. Thus, this move here into the green area is a smaller version of this move here. That also was saying pay attention down here at the end of 2018. There's nothing particularly magical about this chart. It simply speaks to probabilities. And these type of moves are not timing moves. They are simply pay closer attention moves. Let's take a step back and look at the bigger picture. This is S&P 500 as of the close on May 10th, 2019. This is the plunge in January, February 2018. This is the extremely rare plunge late in 2018. Here's the gap that we tweeted about on April 17th. You can see we came back and filled the gap and then closed above the gap here. You can also make an argument that we came back and retested the top of this purple box here. What once acted as resistance, what once acted as resistance, what once acted as resistance may now act as support. You can also make an argument that the market just tested this plunge area here. This is somewhat of a second scare look in here, and then the market reversed and closed back above this blue box. What once acted as resistance, may now act as support. You can't emphasize enough, based on everything that we've covered in recent weeks, we're really only in this area of the table, very, very close to these type of signals. And this table tells us we don't want to assume anything about what the next 30 to 60 to 90 days might look like. Given the look of this chart here and everything we know, it's very, very possible that price could move around this orange box here and still maintain a constructive outlook longer term. Thus, from a mental preparation perspective, we shouldn't be shocked if the S&P 500 decides to revisit the 2725-ish level down here in the next few weeks. As always, we'll continue to take it day by day. Bullish probabilities will improve if price can get into this area here, make a higher high above the previous high, and hold above that high. Until that happens, we have to have very realistic expectations about risk going forward. Something that we already covered in the May 6th short takes post. From a should we try to hang in there perspective, it might be helpful to know in these historical cases, after the volatile 90-day period here, so this date here is 90 days from this date here, if we held through this volatility, was it worth it? Which is another way of saying, if we held through these drawdowns, what happened next in the S&P 500? So now we'll walk forward from these dates here and fill in this table here. And from a historical perspective, the answer is if you hung in there during the volatile period, on average, good things happen looking out 90 days, 180 days, 360 days, 540 days, and 720 calendar days. The average gain, 720 calendar days from this point here, historically in the S&P 500, was 24.55%. The median return was very, very similar, which speaks to consistency, 24.5%. And the maximum return, 42.66%. Worst case, 2011, a negative return of 11%, 180 days out. And in the 1999 case, 720 days out, you were down roughly 6%. But that came after very satisfying gains, telling us to keep an open mind about better than expected outcomes once the period of volatility is behind us. And that falls into the to be determined category. We said the hard evidence that we had in hand during the recent pullback was constructive. And our roadmaps that we've been covering since January of this year can help us illustrate that point using these moving average clusters as a proxy for the data tracked by the model. Very, very difficult to say that the close on Friday, May 10th looks anything like this period here, 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 or here. And we said way back on January 11th that it would be constructive if we could clear and hold above the moving average cluster. Clear and consolidate above, clear and consolidate above, clear and consolidate above, consolidation above the moving average cluster. Thus far, we have price consolidating above upward sloping moving averages. Based on the longer term facts that we have in hand on Friday, May 10th, 2019, there's nothing particularly alarming here yet. That very well may be subject to change. We take it day by day. Every single comment made in this video is based on the facts that we have in hand on Friday, May 10th, 2019. If those facts change, our assessment of the probabilities will change as well. It's also interesting to note that this week, Warren Buffett also made somewhat of a facts-in-hand assessment of stock valuations. He basically said stocks are ridiculously cheap if interest rates stay at these levels. And just as we caveated our comments on the previous slide based on the facts in hand as of May 10th, Mr. Buffett made it very clear that these comments are based on present-day interest rate levels, and those are obviously subject to change. But it's also interesting to note Berkshire Hathaway's portfolio and holdings as of the end of last year. This tweet, as of the close on May 8th, which is right here, Wednesday, still does a good job summarizing the bigger picture. Thus far, we really haven't seen anything that's unexpected or abnormal from a present-day facts perspective, nor a historical perspective. But given the fluid situation with trade, and it may be fluid for another 20 to 30 calendar days at least, it's incredibly important that we head into next week and every week with that flexible, unbiased, and open mind. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.